The wrong side of the property market is an uncomfortable place to be. Historically speaking, the market has always gone up and down. Generically speaking, the market has always gone up over a long period of time. However, it is possible to buy a property at the peak of the property cycle and then go into a crash. This is known as winner's curse. But why do prices keep going up and up in the UK over time? Well, we live on a tiny island with a lot of limited space, and a lot of that space is protected greenbelt or national park land that cannot be built upon. But typically, the housing market in the UK goes through a cycle on average every 18 years, and knowing and understanding this can be one of the most powerful tools as a property investor. By learning this, I now understand why property prices continually go up over the long period of time. I understand why there are peaks and troughs in the market, and I also understand that crashes happen due to the way the system works. Hey guys, welcome back to the channel. If you're new here, my name's Matt. I work for a bank by day, I invest in property on the side, and on this channel we explore all things money, finance and property investing to help people lead a more financially savvy life. So why does property and land increase over time? Well, it goes back to an age-old concept of supply versus demand. Tons of products and services that we use every single day always go up in line with inflation, but in theory it shouldn't change too much in how much it costs relative to inflation at that time. This means that if you have too much supply, then therefore the cost is going to go down. Now, traditionally with any market, product or service, those always stay roughly in line. Therefore, the price is quite stable and doesn't go up too much. But when one of these starts to tip the scale, this is when we start to see price movements. To bring this to life, imagine there is a village with one takeaway in that particular place. Now, if everyone all of a sudden started ordering a takeaway every single day in the village, then there is way too much demand and not enough supply. This means that the restaurant owners in the takeaway could then up their prices, and those that are desperate enough to still get a takeaway every single day will pay those higher prices. And then in theory, the restaurant will keep increasing the prices until people start to tail off a little bit, but they get all of the extra money and they still get to keep all of that demand. But then let's say another entrepreneurial resident in the village spots this opportunity and also opens a second similar restaurant. Now, what's changed here all of a sudden is that there is more supply. And because there's more supply to meet that demand, that means that the supply has to lower their prices to stay competitive because there is a little bit too much supply now. And in theory, this basic principle and concept is what balances out prices over the long run: supply versus demand, which equals competition. But with land and property, this is a little bit different because there is only so much land to go around in the entire world, and we can't just magic up random bits of land that don't exist. This means in the UK, with a limited supply and an ever-growing demand through an increasing population, this is why over the long run, property prices and land generally increase. It's not actually about the property itself, because building a property in London costs the exact same to build a property in Leeds. It's actually the land that forces this market. And as prices go up and up and up, and they start to really increase above wages, this is where all of a sudden property and land becomes even more affordable, and then we see the inevitable crash. And this happens time and time again, and has happened throughout history. And it really surges just before the crash because there's so much confidence in the market with all the prices increasing. Banks' confidence also increase, and they start to lend more against properties, which means that the average person who might not have the best affordability can still get a 95% loan to value mortgage. And this is dangerous because when all of a sudden the market crashes, this could mean that that person is in negative equity. And when we reach the point of affordability where houses cost that little bit too much compared to wages and the crash happens, this is also when banks start to rein in their credit risk and they become a little bit more hesitant when lending. This is also the time where we then start to see that businesses start to fail, which ultimately impacts the stock market and employment rates. Everybody will probably see a few of these cycles happen in their lifetime where property prices go up, they crash, and then they go up again and crash again. But that baseline is higher every single time because we still have the fundamental principle: there is not enough land available in the UK, therefore we have a limited supply and a growing demand, and that's why it always increases. An economist named Fred Harrison is the person who coined the term the 18-year property cycle, and he looked through hundreds of years worth of property data, and that's where he got to the understanding that the average number is around 18 years. This can change, and it could change by a few years either direction, and there are also lots of other external factors like politics and viruses that can change and chop this. But with all this in mind, there are a few phases and signals that you can be looking out for to ensure that you're ahead of the game and aware of what's happening in the market. So let's explore the signals and stages of the property cycle. So let's start from the very beginning, and we've just had a crash, and this is where the recovery period starts. During this phase, we've just come out of a recession, and a lot of people have been burnt, may have lost their job, jobs or businesses may have failed, but confidence is just starting to increase. The average amateur investor is nowhere to be seen in the market at this point, but this is where smart, intelligent investors can then start to buy property at the lowest point. Now, it is impossible to time the market correctly, but just understanding and knowing that it's at the bottom somewhere, even if it continues to go down a little bit further in the future, you're still at the bottom of the market overall, and over time, that's going to increase and you'll be in profit. But we'll also still see some panic during this time, with the market in recession and going down still, and we don't really know where the bottom is going to be. Inexperienced landlords or owner-occupiers might start selling their homes because they want to cash out before they lose too much money. The problem is here that they may have bought at a high and are actually selling at a low, which is the worst way to buy and sell any kind of investment. On the flip side, it means that there are a lot of fantastic deals that traditionally are a lot cheaper because they're being sold at a low price. And next we enter the recovery phase. Confidence is starting to increase in the market, more sales are happening, and prices are starting to increase rather than decrease. This means that there's a change in the news headlines and things are starting to look a little bit more positive. A good signal to look out for here is when you see big companies or pension funds buying distressed portfolios or very large buildings to invest into. This is when they are making decisions based off data and market intelligence, and this is where you'll start to see intelligent investors also make their first moves again in property to ride that first recovery wave out of the recession and the property dip. And then we enter the mid-cycle dip. This is where we've had a good few years of recovery and growth, but then things start to go a little bit wobbly, house prices go down a little bit after some sustained growth, and people start to panic. But traditionally, after we see a very small dip, prices then start to surge and increase. Any smart investors who bought at the very bottom of the market may also cash out at this point to try and realize some of the profits. But as this mid-cycle dip comes to an end, this is where we really hit the exciting part. This is the explosive phase. The mid-cycle dip quickly gives way to the most brutal and relentless part of the cycle, which is all about the explosive growth. This is where property prices increase massively, and we see incredible headlines where property prices are increasing every single day at record sales. Confidence in the market is very strong, and banks start to relax their lending criteria, which is at the point that we start to see headlines like the new world's tallest building or the biggest shopping centre in the world has been built. All of these crazy ambitious projects are starting to happen due to the confidence in the overall market. As prices increase at a really fast speed and equity is growing within people's properties, two things tend to happen. Either people trying to move up the property ladder to try and cash in before it goes too high and becomes too unaffordable, or people take that equity and refinance it to spend it on a really fancy car or a holiday and actually waste that money away. And it's at this very moment where people are enjoying all of this growth and trying to get into the action, where property investors that are more experienced and are looking at the data are quietly selling off their properties and portfolio to generate as much profit as possible. Because as we start to get to the very top of that peak and the top of the explosive growth, the 2 to 3 years as you hit the peak is known as the winner's curse. Now, this is the worst time to buy a property, because if you buy the peak and then a crash happens, it's going to take a very long time to recoup all of that equity and gain some profit back in a property. And as everything comes to a head, we hit a peak and then there's another crash again. Everything happens all over again. Market confidence is lower, banks are lending less to the market, and over time, we then repeat the 18-year property cycle. If you want my own opinion, I have 6 rules about the property market cycle. Firstly, do not panic. Prices will go up, prices will go down, and there is a huge fear of missing out. But the key here is to use your brain and trust the data that's in front of you, and especially ignore news headlines. Secondly is don't buy high and sell low. Just trust the data, and by understanding the general concept of a property market cycle, you can avoid buying at the wrong time and selling at the wrong time. Thirdly is don't get carried away in the winner's curse phase. This is where we see loads of growth in the property market, and everyone wants in to try and get as much growth as possible. The problem is that they jump in right at the top, there's a little bit of gain, and then we hit the crash. Fourth is don't read the headlines. Typically, whatever the headlines are saying is the opposite of what you should be doing. When they're saying that the property market is amazing and you should be buying, actually you should be selling. When they're saying that it's all doom and gloom and everything's going downwards, that's when you should be buying. And then fifth and sixth is be a seller when everyone's buying and be a buyer when everyone is selling. There's an argument that in 2021, the cycle may have been drastically broken due to huge different consequences. We've never seen a pandemic like this in recent times, so anything could really happen and all the rules might be completely thrown out the window. So it's definitely one to watch, keep checking the data and see what happens. The 18-year property cycle is not a hard and fast rule to follow, but it's a general concept that you should understand in terms of supply and demand. If you made it this far in the video, I'd love to have you as a subscriber on the channel. There's always room for one more. I've got loads of other great videos like this one on the top here, which is my day in the life of a property investor, or you can check out the one on the bottom, which is my 2021 buy-to-let hotspots in the UK. So feel free to choose one of these, and I'll see you on the other side.